Type of mutual funds. Mutual funds are classified into two types, open-ended and closed-ended. Whenever we say a fund, it means a scheme. The terms scheme and fund are interchangeably used. We hardly use the term scheme. Generally, we follow or we mention a scheme as a fund. So, mutual funds are divided into two types. We have open-ended funds and we have closed-ended funds. So, let us see what is open-ended and what is closed-ended and what is the difference between these two in the coming slides. Open-ended funds. Open-ended funds are those in which an investor can enter and exit at any point of time. There is no locking period as such. He can invest at any point of time, he can withdraw money at any point of time. AMC is the entity which will sell units as well as which will buy back the units in case of open-end funds. Normally, open-end funds can be bought during NFO period, that is 15-day period, as well as ongoing transactions are also allowed. That is, you can buy units of open-end schemes anytime. Post NFO, that is after NFO, AMC will offer you units and they will also offer the liquidity part. That is, whenever you need money back, you can approach AMC, you can repurchase your units or you can redeem your units. So, this is the advantage with open-end funds. They are highly liquid and there is no fixed maturity for open-end funds. And let us see about closed-end funds and how it differs from open-end. In case of closed-end funds, investors are allowed to enter during NFO period, that is during the first 15-day period. They can buy units from AMC at a price of rupees 10 or face value. Once the NFO is over, investors are not allowed to buy from AMC directly. In the sense, post NFO purchase is not entertained by AMC. Every closed-end fund has a lock-in period. It could be 1 year, 3 years, 5 years, etc. It varies from AMC to AMC, fund to fund. So, investors are not allowed to redeem units during the lock-in period. So, that is why SEBI has come up with a regulation that all closed-end funds should be compulsorily listed in a stock market. So, post NFO, if an investor wants to sell units or wants to buy units, they should do it only through exchange platform. In the sense, existing investors who bought units during NFO can exit the scheme through exchange platform. The procedure is they should convert their units into demat form. They should open demat account and trading account with a stockbroker. They should demat their units first and they have to sell through a stockbroker. And investors who missed the opportunity of buying units during NFO, they can always do the same, but not through AMC. They have to buy through exchange platform. They will be buying from investors who are ready to offer units. From existing investors, they have to buy. So, liquidity becomes an issue in case of closed-end funds. In the sense, if no investor is willing to buy, then you cannot offer your units or you cannot sell your units. So, that becomes an issue in case of closed-end funds. Liquidity is a main concern. Whereas, in case of open-end funds, you do not have to worry about the liquidity part because AMC will take care of that. AMC will buy back units from you. AMC provides redemption facility. Here, redemption facility is not provided by AMC. So, that is the main difference. And when it comes to closed-end funds, you have to bear in your mind that liquidity is an issue before taking a decision to invest in it. So, these are the main differences between open-end and closed-end funds. Funds can be classified based on investment objectives also, that we will be seeing in the coming slides. Thank you.